Okay, folks, welcome back. This is our midweek review for December 11th, 2019. All right, so we've got our run on the sell side liquidity pool we were looking for a couple weeks now. And before I get into it, I just want you to think about some of the levels I gave you in regards to higher time frame perspective. The previous equal highs for 2018 here. That's what this line is here. And this line here is the old 2018 high. And here's that high. Okay. And I'll zoom out so you guys can see that a little bit better. So the full 2018, no high was higher than this one. This one looks like it's equal, but it's just slightly under. This one's 97.71. So we have a run on the sell side liquidity pool. In here, and we had a large range day, which is what I outlined on the weekend. I said that we'd have the largest volatility and fireworks, if you will, on Wednesday and Thursday. We still have the Parliament vote for tomorrow for GBP, and we'll see if the British pound can rally further and see further weakness on the dollar index. Now, should we get acceleration on the downside and a deeper run, because this admittedly it's shallow, but still nonetheless we did run below the old lows. The low on this candle here comes in at 97.11, and today the low was 97.04. So certainly a run on sell side liquidity. This is 0.3 as a low, 97.03. I thought for sure we'd punch below that as well because we were watching this one. If we get any continuation lower, we'll be looking for these equal lows in here, sell side liquidity, and the fair value gap in the form of a busy buy side imbalance, sell side inefficiency, as we've been referring to for months. Should this thing collapse and go lower, this is the discounted rate that I would like should we have a more pronounced decline. Now with the 2018 high, which is this red line in here, I kind of want to bring that in, and just remember we had these lows in here. We had sell side liquidity. We ran through that. I said when we came back up in here, we wicked through it and rebalanced. It was only like 1 pip of a fair value gap in here. It balanced that, and I said we would look for it to continue going lower, and we did in fact get that. Go back to the recordings back in here ahead of this run here, and the fair value gap that I had outlined up here. I said that the only way we would go bullish is if we traded through that. Didn't get that at all. We saw the buy side liquidity tagged as we were expecting, and then reversal moving lower for sell side liquidity, which has been removed because we've now exhausted that, and I only have this one on here now shaded a lightly gray color that it basically annotate the fact that we've already ran sell side liquidity. So sell side liquidity now moves to here, and I'm going to just basically put it in the center of the BISI so it accommodates both things, the equal lows and also the imbalance on the upside. So next downside objective is 96.60, then 96.40 respectively. So I've outlined all of this business here, so I want to be able to take this off the chart now since we've seen it pan out. Just be mindful that these equal highs here for the initial highs for 2018, I mentioned and outlined all of these multiple attempts to go higher, and then we broke down and we tried again several times to get through it again, and it just simply wouldn't offer any traction on the upside. So make sure your charts in your study journal have this in it. I just want to be able to remove it so that way the charts get clean again. All right, so that's that. And the buy side liquidity rests above the high here now. So this will change to there. Okay, so this is what our chart looks like now. Beautiful, beautiful delivery of price. Now, I want to kind of like talk a little bit about the lesson for this week. I'm going to be brief as I possibly can because I don't want the video to be too long, because I'm going to go right into Eurodollar and then GBP and then call it a day, and we'll catch back up with each other on Friday at the weekend review. All right, so I want to talk a little bit about the absence of fair value gaps when there isn't a fair value gap, but we have a big down close candle or an up close candle that creates an imbalance. We initially reach for the protocol of a immediate rebalance. Now, immediate rebalance is the opposite of a fair value gap, which is a deferred rebalance. Now, I talk a little bit more about what an immediate rebalance is. You can find that in the weekly commentaries. I don't know exactly what day it is, so just look in the topics, just scroll through it and you'll see it. You can also use the forum search function, probably find it faster that way as well. But I kind of like want to like prod you in the direction where we're going for 2020. There is no fair value gap, assuming in price. What could we use instead of a fair value gap that would still constitute a measure of rebalance? I want you to look at the wicks. Now, I've taught this already. It's consequent encroachment, which is the same as a gap, but when it's on a wick, because the wick is a gap as well. Now, again, I define that as a gap. Whatever you learned from other people and other disciplines and other retail stuff, just forget it, okay, because this is the gospel. When you have a wick, the wick will act as a gap. Now, you want to know what the high of the wick is and the low of the wick, and the same thing for a tail. Now, tail is underneath the candle and a wick is above the candle. What I'm explaining applies to both. So if you're going to consider a wick, which is this here, this little thin line which creates the high and then where the price candle closes, that's your wick. So you want to know the low of the wick, the high of the wick, and an exact middle point, which is consequent encroachment. Same thing with a tail. Okay, you want to know the highest point of the wick and the lowest point of the wick, and then the consequent encroachment, which is the midpoint of the tail, okay, or the opposite end of this down close candle, but doesn't make the body. Okay, so those three price levels on a wick or a tail are very significant. If there's an absence of a fair value gap, for instance, look at today. I'm going to zoom in a little bit on this. And we'll scrunch this up. We'll spread it out, actually, not crunch it up. All right, so this run here, okay, from the open, trading up. Now, we did have a little bit of a down close candle. We came off the lows yesterday. Then we opened, traded up, creating a market protraction, the Judas swing. And it trades back up, and it doesn't go just to the low of that candle as you might expect for a fair value gap. It goes deeper. It goes higher than that, okay? So if we do not have a fair value gap, or it closes a fair value gap, do we completely abandon the idea of bearishness after rebalancing? No. Look at this candle's tail. All right, so if there's a immediate rebalance in here, well, there's no fair value gap. We have open, which trades back up into, not the previous day, but on this candle, which is Monday's trading. This candle's tail, okay, this candle's tail right here, up to its close. You measure that with a fib, and you get the consequent encroachment of that. So even though we rebalance back to the low of the candle and trades through it, what's the next logical level we would expect sensitivity with the consequent encroachment of that wick, or this, in other words, tail. We get that perfectly, and then it runs down for the sell side liquidity. It occurs also here last week on Friday when the market traded back up into the 1 pip fair value gap in here, but also the tail. Okay, get the close to the low, run your fib on that, draw that out in time, and you'll see that we hit the consequent encroachment of that as well, and then it runs lower. So what am I showing you here? I'm teaching you how to use the wicks, cutting through candles, breaking all the rules of supply and demand, as it's taught over at Online Trade Academy and Sam Seiden's group. And again, not trying to be disrespectful, but I have new people in here, and they're saying really draw a distinction between the two disciplines, and it's not even close to me. Okay, so just know that there is a specific algorithmic engine in price that pulls retracements to specific and logical levels that repeat a lot. It doesn't happen every single time, but these are things that I look for. So when I say things like I'm looking for very generic signatures in price action, this is one of them. So we have the tail here from the close to the low, split that in half, there's consequent encroachment, and that's what the retracement goes to exactly. Now, I know what some of you are thinking, well, how do I know which candle to do that on? It will be taught more at the charter level, but for now, I'm just introducing the concept because I want you to start studying it and looking at it. Every time we have a wick or a tail, those are gaps, and that gap is important. You want to know what the highest point and the lowest point of that wick or tail, and then split that in half. That's consequent encroachment. You see it happening today here, where the open trades up for market protraction, trades up into Monday's tail, consequent encroachment, hits it, and then trades lower. This candle here, it's closed to low, split that in half, and you can see prices trading up into that as well. And then we have the rollover. Now, across your data feeds, there's going to be slight variances of when it gets to consequent encroachment, it goes 1 pip above consequent encroachment or falls 1 pip short below it. You're going to have to allow for that anomaly because the broker has the right to open the spread within a specific range that is allowed. Okay, and what is allowed, I don't have a definitive answer for that, but it can't be 20 pips, let's put it that way. Is it reasonable to anticipate as much as 3 pips difference between other brokers? Yes, I think that's reasonable. Is it nice to see that much of a difference? No, I wish it was like futures contract prices where everybody sees the same price. Bottom line is this is one of those inherent things you gotta have to accept when you're trading Forex. So, and again, which is the reason why we're using one medium always with the discussions. We went from using a demo account from previous brokers to now simply using TradingView. So now we're not even using a demo account. We're just talking about price alone. There's no trade advice here. There's no follow me signal spoon feeding type thing. I'm only talking about price on a chart platform. So there's no demo account now. There's no live account. There's none of those things associated with what I'm saying. So now we're only dealing with price action, which is really the heart of this mentorship. So I want you to focus on what I taught initially as it relates to consequent encroachment and the wicks and tails on candles. When there is a move beyond a fair value gap, in other words, if the fair value gap is closed and filled in, and it goes above the high of a premium fair value gap, or if it goes below the low of a discount fair value gap, just look at the candle prior, okay, in this case here, because we do have a fair value gap in here that I mentioned on the weekend review. It went 1 pip into it and above, but it went right into the middle of this candle's tail, okay, and it went right up into it and stopped dead in its tracks, and then we saw it move exactly like I said it would for this week. This concept, coupled with fair value gaps or an absence of a fair value gap, I don't need to have a fair value gap. Okay, we just recently got on this kick with it because they're easy to spot, they're fun, they're very visual representations of where the market should go to rebalance, and it could be used as a target or it could be used as an entry technique. It depends on the context of what you're trading and what the market's providing at the moment. The wicks and the tails, using the consequent encroachment of that gap, which makes the wick or the tail of a candle, those levels are very important, just as important as a candle's high or low is. We have that wick or tail of the candle. We treat that just like an individual candle, an individual time frame, if you will. So those levels are very, very important. IPTA will remember these specific levels and come back to them, rebalance, and then move back in the direction like we just called for last weekend. We see it come to fruition again on the charts. Okay, so we looked for the run above these equal highs. It ran through, came down, collapsed, ran the sell side liquidity that we were looking for here, came back, rebalanced. I said it was okay to allow it to go up into this gap, fair value gap. And then I said we were going to look for it to continue rolling over next week. And now here we are. It's Wednesday, and we saw that, in fact, come to fruition. Okay, to script. Can't ask for anything better than that. I want you to also look at the euro dollar. The same way we're outlining this here, okay, we're going to look at euro dollar the same way now. So if we go to euro, all right, so now we're looking at the euro dollar. This is the daily chart of the euro. We do have the buy side liquidity pool here. Is the next upside objective. That's what we were looking for. Remember these equal lows, I said that we would probably come back down, rebalance, and recapitalize this bullish order block after running the equal lows. I want to see it trade down and trade higher, then make a run for the buy side liquidity. After overcoming the SIBI here, sell side imbalance, buy side inefficiency, fair value gap. So all of this void on the downside offered no real buy side until we got into here. 80% of that gap was closed in. We saw this big drop off, traded back down into consequent encroachment of the fair value gap here. And then I said we'll look for resuming of this move higher for the buy side liquidity, and we've got that so far today. But look very closely, really close. We have an open here, market protraction due to swing down, and yes, it closes all the way to the previous day's high. Not this candle here, but the previous day on Monday. We traded down to that and then went through Monday's high. Now, if you're looking for that precision of fair value gaps and you see that dropping lower, it could be a little troubling. Not in the scope of panic, because there wasn't a whole lot of pips in terms of where the high was on Monday and where the low was. If you look at the high on Monday, we have 110.78, and then the low today was 110.70 and 3 pipettes. So really it's 8 pips. It's not big of a deal. But if you take this wick, this candle's wick on Monday, take the low of the wick, the high of the wick in the middle, that's consequent encroachment, draw it out in time. And when you have immediate rebalances, many times you'll have this occur where it trades right down the consequent encroachment. That's your low of the day, and then it explodes on the upside, continuously moving in the higher time frame institutional order flow. Now, I know already your head's buzzing with, okay, which candle do I use? Which wick or which tail do I use? Slow your roll, okay? Just for right now, I want you to start looking at turning points, okay? Go back and look at all your swing points and see if these elements appear, and you'll find there's a number of them. Okay, I don't want to take you to every single one of them and say this is one, this is one, this is one. Your learning is going to be enhanced by you going in and looking for what I'm describing here. Okay, I will give you more detail, but it comes in the charter level. But I want you to look at how the wicks and the tails, and using the consequent encroachment and the high and the low of the wicks or the tails, once there's an immediate rebalance or if there's a fair value gap. Okay, now notice, if this candle had not had a low as it did here, say it had a low here, then we would have a fair value gap. So we would look for a deferred rebalance, where at some point in the future it would come back down into that area, and then we look for a buy. Whenever we have an up candle, okay, a large candle, and it closes on the high, we want to see it open above the previous day's high, and then see if it wants to come back down and immediately rebalance. And it does that. So since there's no fair value gap limitation, okay, in other words, it's not in the chart where it's clear and obvious, we do have a wick here. So you always have to consider with immediate rebalances, you want to see this wick, the high, the consequent encroachment, and the low of that wick. Those levels are going to be very, very sensitive. Just like a propulsion candle, okay, for a bullish propulsion candle, and if you haven't gotten that far yet, you'll see it in the core content. A propulsion candle is another order block that is being supported by a transparent or larger order block, and we don't want to see it trade through the mean threshold of a propulsion candle. Propulsion candles generally keep the sensitivity at the high or the upper 50% of that candle. Very rarely do we see a mean threshold of a bullish order block or a bearish order block give way and then it continue in the order that we would expect the order block to provide a directional bias for. Just like we have the rules for propulsion candles like that, the same thing applies for wicks and tails when we're using it like this. We don't want to see consequent encroachment breached. It should be sensitive there. It might go 1 pip or so beyond it, but generally that's like the last line in the sand. I don't like to use the entire low. For instance, I don't want to see it trade back down to the close of that candle, which is the low of the wick. I want to see it be sensitive at the top or consequent encroachment. So how do we use this? We can use this as an entry technique. We can use it for stop management. We can use it for initial stop loss. It has to be below this threshold and ideally below the low of that wick. So now think about this for a moment. If you're trying to go long using an intraday strategy and we're looking for daily order flow, calling this level here, waiting for the drop down, that's understandable. We could be trading that, buying it, but we don't have to put our stop loss way below this swing low now. We can just use the wick of this candle because it's done its job of rebalancing. So your stop loss can be below the close of this candle, which in this case is 1064 and 6 pip bets. So we could do 1060, okay, and that would be a fair stop placement because it shouldn't go down to that level anyway. If it does, it's problematic. So we've reduced greatly the number of pips, and we didn't even go down to a lower time frame, which is exactly what I'm avoiding to do today because I'm going to try to save time and still talk about what I'm talking about. You don't need the lower time frames to reduce risk or to fine-tune the stop placement. Everything I taught about the daily chart, okay, is still salient, but now I'm teaching you an advanced version of researching the daily chart and getting more details without having to go down into the 4 hour to 1 hour, 15, 5, and whatever minute chart you want to look at. It's not necessary because, like I said, I already know what I'm looking for and I can see it on the daily chart. Give me a daily chart and I'll tell you what's most likely going to happen. And that's the benefit of knowing what I'm teaching, because you don't need to be in the lower time frames. The lower time frames are useful for scalping, for day trading, and also for practice. The higher time frames, I've given you a multitude of intermediate term swings to short term swings, recent months, okay, even with all the difficulties, and you see them panning out. What I'm giving you here today is one more level of higher top shelf ICT content, but I'm not giving it all to you today. I'm just introducing the concept to you because I want you to go into the chart and start looking for these things. Don't be confused, don't be not confused, but you probably will be confused, but don't be discouraged if you don't readily find them easily. Okay, it's okay. As when you get into Charter Member, you'll see that there are lessons that will talk about this, and the Charter members that are already now Charter members are thinking, I don't remember seeing that lesson. That's because I'm about to provide them for you in 2020. But the Charter members, or the members that are not Charter members, they have to wait to get to your level too. Okay, it's not a lesson that's going to just throw out there. So we're looking for continuation on the upside to the buy side liquidity. Tomorrow again we have the Parliament vote for the UK, so we'll see if there is any follow through on the upside with GBP and lower movement for dollar, and this will all spell a run for this area in here. I really like these highs. I think that there are our next objective at 111.80, then 112, big figure, so that's what we're anticipating for euro dollar. And finally, let's go over to GBP USD. All right, and we're going to zoom in here. All right, so I have my measured moves in here, and so I'm drawing a line. Keep an eye on that where it's at. So we had initial run above these equal. Let me zoom out. to provide that context again. These are the highs I was aiming for, and I said we would see those by Christmas, and we got there yesterday. And we have price with the measured move idea. Now, I don't hold fast to these types of things. I like to see a confluence of targeting like that, but anything at this level, the equal highs and just above it, that's sufficient. You know, if you want to break it down to the specifics, the 62 level we were looking for, 132.60, 1 to 132.62. If you want to round it to a 5 level on expansion, we could do 132.65, and that would be a reasonable upside objective. I mentioned how we came back down into this area in here. We hit this multiple times. We did it yesterday and then today, and then sensitivity again came in and sent price higher. This chart, or this pair, I do want to go down into the hourly chart because it's salient for tomorrow. We have sell side liquidity here, shallow run below it, buy side liquidity, shallow run above it, and then we had that punch through, and this is those equal highs from the daily chart that I said that we would see by Christmas. We ran that, peekaboo, it just stuck its head out just for a minute, came all the way down, ran the sell side liquidity in here, kept this low intact, bounced, came down one more time, failed to go lower, and then expanded on the upside. All of this rebalanced, came back down, expanded again. A little bit of an imbalance in here. It would be ideal to keep this lower half of this BISI open, not to see it close completely. I like to see it expand, keep this open, just like it did here. I want to see it do it here. So this could be a breakaway gap, this could be a measuring gap, and that would send us up into the 132.60s, okay, 132.75, something like that. I like how they kept these equal highs in here. So we want to see it more or less come down maybe a little bit more, not much more than that, but then expand up, run for that 132.20, and then expand to the next institutional level, 132.50, and then expand to 132.65, 132.62 in that area, and that would be the measured move. But again, I'm not saying that's going to be the end of it. This thing could go even more based on whatever the vote provides. But I think that it's been a really good lesson for trusting and following along with the commentary and the things that I provide to you, because the dollar had been challenging until we got the price action that started in December 1st. It became real clear what it was likely to do, and now you see it. So how long it takes for you to get through these periods of uncertainty, you want to record that in your journal and talk a little bit about that to yourself and say, you know, I learned a lot about how much time it took, and record how much time we spent in the month of November with a great deal of uncertainty about which side of the dollar it was going to make a run for. And then when things became more clear, you want to identify that also in your journal and talk about how you hopefully have learned something from that and what it is that you learned. Every one of you are going to have a different lesson, something that you've gleaned from November into now the 11th of December. And it's been a really good learning experience because it was really the first time we had adversity where even I was unsure of what was going to happen in terms of the dollar. That is something you're going to encounter. You're going to encounter that dozens of times between now and whenever you end up stopping trading, if you're going to have a long career of it. So if you're going to be doing this 20 years plus like I have, you know, you're going to have dozens of experiences where you're going to have a necessity for new information or more information, because it's not going to be readily available to you by just looking at the chart. You have to get more information and wait, and we had to endure that. So it's not surprising. Okay, it's not surprising that I had 100 people not continue this month. Now maybe some of that has to do with the holidays, it's the end of the year and everybody's saving their money up, but I had already, and if you listen to the videos I did in the beginning of this month and last month, I was telling everyone point blank, if you don't have the wherewithal, you don't have the tenacity to stay with this, and you're too short-sighted to see initial adversity, then you quit. and that's the best thing for you, because I can't fix that part of you. You're going to stay like that. No matter what you see here, you're going to be pessimistic, and you're going to be a problem for yourself, because I already know how to do this stuff. You're here to learn it from me, and I don't have the time and I don't have the energy to try to convince you, because if you're not convinced, you're in the wrong place. So, but it's not because I don't provide the evidence, because it's obviously here, but there's certain psychological barriers that I know as a mentor I'm not going to break through, and I don't waste my time with those individuals anymore. On Baby Pips, I bled my heart out for these people, and it's not worth it. And it may sound evil, it may sound selfish, but I'm not a selfish person. I'm just being honest. I have seen my limitations by doing this mentorship. So I'm glad 100 people left. I'm glad. I don't need your money. I don't care if they come back. If they come back, great. If they don't come back, I don't care either. Okay, because I have weeded, or at least I've done my best to weed out the individuals that can't hack it here. And it's better for them to be here. And just so you know, majority of them are month one people, and that's okay. Month one people, when they first come in, they're overwhelmed because there's too many things. And I had one guy send me an email say, "Can you make these videos shorter and just go right to the point? You think it's going to move here? Put your stop loss here and where to buy and sell." He's asking for a signal service, or she's asking for a signal service. I'm not doing that. I'm telling you what the market's going to most likely do in terms of directional bias, how it gets there. In between me saying where it is right now and where it's going, you have to use the core content and study which is being utilized. If it's a bullish market, you're focusing on the discount arrays, reaching for premium arrays. This is explained to you in core content. I don't need to spell that out in these videos. What you all need is the assistance and my experience of saying what is likely to occur next in terms of up or down, how far, where is it going to reach, and by what time frame, and what's the time horizon for that objective. That's what I'm lending with these commentary videos. Okay, so like I said, it takes work, and a lot of these folks that came in had expectations, I guess, for something else. And you're going to have this again from me. You'll hear it, and it may not apply to you. You may get irritated because I'm saying it, and it doesn't apply to you. So don't talk about it, ICT. But I have a large number of you in here, and I want to be not only a good steward with my own time, but I want to be a help to you in being a good steward with your own time and your money too. Because if you can't think correctly coming in, and if you have toxic thinking about real hardships that's going to occur, and I made no bones about it, November was difficult, and all of a sudden now it's back to the way it was before November. I'm calling moves, they're unfolding, and it's beautiful, it's fun. But as a new trader or developing trader, and someone that puts and plunks down $155, they expect certain things, none of which I was outlining as this is what's going to be given to you. I'm not giving you signals, but I'm going to tell you what's going to happen. And I think some of these new people come in and they have their accounts on standby, and they're trying to mimic or produce winning trades based on the things I say in the commentary. And maybe they burn themselves. Maybe they do what some of the other students here, even in the older group, they still try to trade against my commentary, or arm wrestling. Well, there you go. One of the guys in here said the dollar was turning around. I need to tell everybody all about it. And well, I told you it was going the other direction, not the direction this gentleman was expecting it to do. So I can't make it any plainer than I do. And I'm not going to shorten the videos. I'm going to talk how I talk, and I'm going to teach how I teach. And you're just going to have to grind through it, because I don't work with a script. I don't think about what I'm going to say. I just say it. And if it's germane to the market at the time, that's what I'm looking for. But if I've gone into the video with the expectation of tapping your mental psychology about the markets and trying to say, hey, look, focus here, or don't worry so much about these things, you need to listen to those lessons. Don't just listen for, okay, he said the British pound's going to go to this level and then be a buy. I can do that every single week, and you're not learning anything from that. And I had another gentleman say, please don't stop giving our weekly commentaries with your directional bias and what I think is going to happen. That's going to happen. I'm going to stop eventually. Okay. But I already told you the timeline. I got to get through 12 trading plans before I do that. But you're going to get a different level of teaching that I can't do because I'm trying to do real-time analysis. And I'm not going to listen to other people's suggestions about how they want it done, because this is not Have It Your Way mentorship. I've done that in the first group and it drove me nuts. Okay. And I couldn't focus. It's going to be the way I want it to be done on these two pairs with the dollar, and once in a while dollar CAD, or once in a while Aussie dollar. Okay. So I think that's going to be it for now. Just be mindful again, the Parliament vote is still the last big banger for this week's commentary, or not commentary, this week's calendar. And I don't know what it's going to do. Okay, I think it will go higher, referring to the British pound. And I've already told you I don't want to see certain things occur. Now, it can come back down here and completely rebalance. That's okay. It's permissible. But it would be better to leave it open and just start to tear into it higher. Certainly don't want to see it trade down in here. There's no reason for that. We have a single candle down, single candle up. So we have a balanced price range in here. That's the reason why we see the sensitivity right here. You're probably asking, what caused this? Or I'm going to try to read your mind, or before you actually start thinking about it, probably. This big move here, if you just look at the balanced price range lessons that I gave you in the teachings, that's what this is here. It's going right back down to the balanced price range and sent it up. All right. So that's the business for right now. A little bit of a rant in there. But those of you that sucked it up and went through November, and you're new and you're in the month 2 or month 3, congratulations, because you've exercised a great deal of discipline and trust in yourself, not only in me, but in yourself, that you're making the good decision of learning from someone that can get you through all this stuff. And it's just wonderful to see the positive feedback. I'm not asking for it because this adds more to my email. But just know that it's not necessary for you to give me these warm feedback emails. There was a time in the beginning I was asking for them, and maybe you're hearing me say that stuff in the older videos that I recorded in 2016, 2017, which make up the core content, the lessons you get each month. I don't want you to do that now, okay? Because I get way too many emails, and some of you get frustrated because I can't get to you in time. Or I answer you in emails, not emails, but in conversations like this in the video, because I just don't have the time. And it sounds like I'm blowing you off, and I don't mean it to be that way, but I simply do not have that measure of time to sit down and type out all these long-winded responses, or folks that send me charts and they're asking me, what do you think about this, analysis? And what do you think about that analysis? I can't be like a teacher that grades everybody's individual analysis. You learn by it panning out or it not panning out. And it sounds like the school of hard knocks, but that's really how you learn it here. I tell you what to look for, and then you go out there and you practice with it. I'm going to guide you with directional bias midweek and end of the week and tell you what I think is going to happen. So I'm giving you 80% of the battle. You have to practice in that understanding, and that's what's required here, because I'm not going to hold your hand and tell you get in here, get out here, and put your stop here. I'm not going to do that. Now, I will prompt you based on the things I say in the commentary. Pay the trader. These are milestones in the market moves that we're looking for. So when I tweet that, it's important for you to note where I'm telling you, because they're logical levels where you would be otherwise expected to take some partial or completely collapse the trade. Where you are in that spectrum, if you're taking a partial or holding for more, that's all relevant to what type of trader you are. Because if we're framing it on a daily chart, you may be holding it for a longer type of move and not just simply a intraday chart swing, or a day trade, or a daily candle. You may be looking for a weekly range expansion and taking some measure of partial off, but leaving another portion on for a much significant run higher. For instance, like we are looking at the euro. Euro has a very clear equal high. We're going to be expecting those equal highs to be an upside draw on liquidity. So we'll see if that actually happens or not. But nonetheless, I think that's going to be it for now. There should be volatility tomorrow for GBP USD. How much and what type of profile we get, I don't know. I don't know. I just think that we've seen the move I wanted to see. We've seen it now twice. It ran up above here. This is that old daily high, or old daily highs that I was calling for Christmas. So we've done that again. We left equal highs. So I think they'll make another attempt to run up here. I wouldn't be surprised if we get a run up and then they come all the way back down and slam it below these here, just to clear out the board one more time, and then maybe get a real move after that. What is that real move? Is it going to be a continuation on the upside and weaker dollar, or is it going to be a continuation lower and then the dollar comes back with some strength? That I don't know. Okay, but that's the benefit of trading like this in this market condition. Knowing where to cherry pick your moves and then trying not to be lulled in or buy into these long-term moves that really aren't established yet. Okay, so just you want to cherry pick your setups, looking for runs on liquidity that are very low resistance, and keep it short and sweet. Try not to be, in everything, and try not to hold for every possible move, because everything is still in transition right now. We're in a very large consolidation, like I mentioned on Twitter. If you look at oil market, look at the bond market, the dollar, all these markets, and gold, they're in a large consolidation on their daily charts. Something big is forming. I just don't know which side of the marketplace it's going to occur yet. I will eventually see it when it's there, but for now, we day trade or scalp. It's as simple as that. And if you're going to be in here short-term trading, be diligent about taking 60 to 70% off your initial partial. That way, you've really significantly paid yourself, because these prolonged moves may not pan out, and it may retrace on you deeper and spend more time against your idea longer than you're willing to hold, and then it completely will mess up your psychology. So again, this is the reason why I focus on telling you in these commentaries that we're in a day trader's market, or in a mode of price delivery that warrants short-term intraday trading. I don't say that just to try to convince you into being a short-term intraday trader. I'm telling you that because of the market profiling concepts that I teach. These templates, they're in my head, and that's how I'm interpreting price. So if you're here to learn from me, that's the language I use, and you have to understand that if I'm telling you that, there's a reason for it. It's significant. It's salient to your understanding, your development, and that way it should help you suppress those desires to be long-term traders, because those long-term trades aren't necessarily that clear right now. And while traders can come to me 6, 7, 8 months from now and say, see, I had it right, well, that's great. Try to do it every single time we go in this environment, and you're going to see that it's not like that. I've done all those types of things before, and like I said, I'm going to rely on my experience. I'm not going to have anybody else change the way I do things around here. I like how I'm doing it. The majority of you, and there's a large group in here, like what I'm doing, how I'm doing it. And if you're new, or if you're just now coming in a couple months and you feel like it should be done a different way just for you, with all due respect, I'm not doing that. Okay, this is the way it is. And if it's not meeting your expectations, nothing keeps you here except for you making your payment and following the rules. If you don't want to continue, like I said, I invited everybody else last month before we rolled into December. If you're not ready for this, if you're not ready to get out here and do the work and encounter some adversity and uncertainty and plow through that and wait for these markets to return back to a point of where we can predict certain things, then trading's not going to be for you. Not because I'm not the right mentor, because you're not ready. No one's going to be able to train you because you have expectations that are unrealistic. All right. So that, my friends, is going to be it. I will catch up with you by way of Twitter if anything is noteworthy for GBP relating to the Parliament vote. And otherwise, I will catch up with you by way of the market review, 5:30 p.m. Friday. I should have it up this weekend. Well, not this weekend because I have to have the weekend to myself, but nonetheless, Friday, 5:30 p.m. my local time, it should be up. I'm not tweeting the links on these videos anymore. You're just going to have to come and get to it at 5:30 because it'll be there. All right. Enjoy your week. Be safe, and I'll catch up with you when I catch up with you.